Hello everybody. Um, this video is for the second part of the Implied Volatility project. I'm recording in my office, so if you hear a few outside noises, it's exam week, so you know how that goes. Anyway, so this is a fairly brief outline of what you're going to need to do. There's a few little tricks you got to be careful about, but other than that, everything should be fine. This is the implied volatility worksheet that came up with in the first section. Again, we're working for 3M. The implied volatility here was the value weighted or the trade weighted volatility based on the number of trades. There was 287 trades that were at the ask and 43 trades that were at the, 287 trades that were for the call, 43 trades that were for the put. So we're just weighting the implied volatilities that are coming from both these guys to get an annual implied volatility of 14.11%. Now what we need to do is first is to convert the implied volatility, and this is sigma, into a daily variance. So what we're going to do is take the implied volatility and square it. It's going to go from sigma to sigma squared. So we're going from a volatility to a variance. And then we're dividing it by 252 for the number of trading days. We're not dividing it by the square root of 252 because we're working with a variance, not a volatility. So this becomes the implied volatility, or the daily volatility that's implied from the option. And what we want to do then is, this is my sharp exponentially weighted variance covariance matrix. First thing I want to note is that the weights that I'm using up here are the ones that came from my sharp optimal portfolio. So this is my sharp optimal portfolio 47.18.5, and then this is my minimum variance portfolio 27.55.16.47. So those are the weights that you want to definitely use for these calculations. I'm going to go ahead and get rid of that one. And then I'm coming over here. This is from the EWMA project. We want to take this particular sheet and copy it. So that's a right click here down on the tab, move and copy. We're going to create a copy, and we're going to the implied volatility variable, and I'm just going to dump it in front of sheet 3. And here it is. Now I'm on the implied volatility. One thing I want to note is you'll notice that this is variance.xlsx, so it's referencing that other file. We don't want that because when the other file updates, this thing is going to go ahead and change. Obviously, we're going to need to mechanically or physically change our weights. So, right, you just type it in. It's 47, 18, 5, 9, and 20. In this little section here, like I said, I don't want this var. It's the only spot that's going to show up. Everything else is just going to come through fine. The equations aren't going to be referencing alternate positions. So I'm going to go back to my covariance matrix. So this is the var RB. And what I want to do is just copy this guy over. We're going to do a Control C to highlight it for the copy. And then when I come over here to actually paste it, highlight the area, go under the paste, and all we want is the numbers. So now instead of having us reference back to this particular sheet, it's just the other file. It's just the number that happens to be sitting in here. So the basic idea is that with my weights, what I'm trying to do is figure out what happens to the value at risk based on this implied volatility. So we just want this number. Come back over to, we're going to set this equal to my 3M implied volatility, my daily volatility calculation. And there we go. And what you'll do is for each one of your stocks in the in your portfolio, you're going to change the diagonal values. So 3M, 3M, DD, DD, UPS, UPS, Home Depot, Procter & Gamble, Procter & Gamble. So these are the ones that are just going to get replaced. Unfortunately, mathematically speaking, there's no way to use implied volatilities from options to get the covariances. So we're just going to assume that the covariances stay consistent, and just the variances are going to change. So the way the stocks move with respect to each other stays consistent. The underlying volatility of each individual stock may go up. And what you'll see here is that we dropped from 0.51 to 0.50. So by using the implied volatility, which is looking forward, it may give us a better estimate of what the daily volatility of the overall portfolio is going to be. In this case, it brought it down slightly. So what the option is saying is that in the future, we think volatility is going to go down, which of course is going to decrease my value at risk. My annual volatility would drop as well. My Sharpe ratio would increase. This leverage should be at 0%. Maybe I entered one of my values. It's probably just a rounding error. In the underlying, in other words, in the actual variance covariance matrix, this is 26.3, so I'm off by 1%, but that's okay. Don't worry too much about that. You can also, instead of typing them in, you can come back here, hit a Control-C to copy the exact values that are there. Come over to your, there we go. So that's going to give us an exact number. Of course, those are the wrong weights. I should have gone back to my Sharpe optimal portfolio configuration to do the copy and paste. Anyway, so don't worry. I mean, your 99% here is not that big a deal. In reality, use the copy and paste function, so it brings in all the decimal points that are associated with it. All right, so that's just the basic idea, and what you're going to do it is for the Sharpe optimal portfolio using the exponentially weighted moving average variance covariance matrix. You're going to do it for the Sharpe optimal portfolio using the equally weighted, so this is where we used 80 days of returns to estimate the variance covariance matrix. And we'll do the same thing for the minimum variance portfolio, and finally for the minimum variance portfolio based on the equally weighted. So minimum variance portfolio exponentially weighted, minimum variance portfolio equally weighted. And what you'll do, I've done it for this one, we'll just set it equal. We'll just go to the next one, we'll change this number so that it's equal to this guy, which changes our value at risk slightly. Do the same thing here, we set that number equal to the implied volatility. And then again, finally for our minimum variance portfolio, equally weighted, this is just going to equal that one as well. So this, basically what we're doing is generating the variance covariance matrix using the most recent 80 days. Let me emphasize this particular point. In practice, what you would do is use the most recent 80 days. So up through today, or up through yesterday actually, because there's no today, well, the market has closed now. So up through today, it's 2:27, so the market closed at 2 o'clock. So up through today, the prices, and then you do your exponentially weighted moving average, and you do your equally weighted moving average, again using 80 days or whatever number of days you select. And then do your value at risk calculations, and then as an add-on to that, you would use the same variance covariance matrix and substitute in the implied volatilities on the diagonal. So where the first two methods are based strictly on historical data. The implied volatility is based on everybody's expectations of the future. Now, again, in theory, the implied volatility should give you a better estimate of what the daily variance is, therefore the value at risk. Therefore, it also tells you more completely when you want to hedge and when you don't want to hedge. And the idea of hedging versus not hedging is if the underlying, when I form my portfolio, if I was willing to accept a 20% annual volatility, and right now the annual volatility is right here, it says 10.7%, then there's no reason to do any kind of hedging. It's not unless I'm willing to accept the 20% annual volatility and I find out that the spot estimate of volatility is 24% or 25%, or maybe even 30%. Now I want to start thinking really seriously about taking out hedge positions, because that represents a big increase in risk. When the risk goes up relative to what I normally would take, it makes sense to go ahead and take out insurance. So that's the idea. What you want to do is then talk about the differences in the estimates. In your case, I don't want you to spend the time to use the most recent 80 days. Just use the variance covariance matrix that you already have set up, and then talk about, explain the process of using the implied volatilities. Explain where your risk position is. Are you above, below, or at the same risk that you took on when you originally started and formed your portfolio? Does it make sense to take out an insurance position? And what kind of insurance position do you want to take out? All right? Do you want to use the cross-hedge technique that we've talked about? Do you want to use the hedging technique of using just options on the underlying stocks? So when I look at this, right, I mean, I know originally what the annual variance was when I selected 3M to be in there. If the implied volatility, go back here, if the implied volatility is 14.14%, when I selected 3M to be in my portfolio, I think the implied the volatility, the historic volatility calculation showed me to be something like 18 or 20%. So this one is below the risk I was willing to take on at the beginning, and therefore maybe not a good candidate for insurance. As much as I would like to have, from a teaching standpoint, to have the market on the verge of collapse so that you could see how this works in an adverse market, unfortunately the market's not adverse right now. It's a low volatility bear market or bull market that's moving up, and these are not times that you really want to take out insurance. These are times where you want to use option trading strategies and hedging trading strategies to try and increase the beta of your portfolio, take on more risk, and ride the wave up as much as possible. All right, so that's the general methodology that you're going to be looking at. I want to point out two other things real quick. When I sum up this column, this number right here is the total contribution of risk to from 3M in my portfolio. So it's the risk of 3M plus the covariances. So we see here that 3M has a positive volatility to it, as it should, but it's also negatively correlated with two of the other stocks in the portfolio, meaning that these two stocks, which are UPS and Home Depot, are reducing the risk that's coming from 3M. So another thing that you want to look at is what is the sum of this column on an annualized basis or a daily basis relative to when I first started the portfolio. Point being here is that in a rising market, there tends to be less covariance. In other words, we can get negative covariances between stocks. Remember that by diversifying the portfolio, we're trying to get rid of unsystematic risk, but we're still going to be exposed to systematic risk. So if you just think about it, suppose the shooting war breaks out between Iran and Saudi Arabia. That's bad news. That's a systematic risk for the entire market. All stocks are going to move down. Well, if all stocks move down, that also means that the covariance between the stocks, it's these guys right here, are all going to become positive. The stock is always moving, all the stocks are moving down, they're all moving down together. In which case, even though the underlying variance or the implied volatility may not have moved up very much, the total risk incorporated by this stock in the portfolio can increase. So you may, another reasonable part for your explanation and your analysis is to include a comparison of these summed tables here, the sum columns. So each column that you add together represents the contribution of 3M to the total risk of the portfolio, or DD. So it's a variance plus all the covariances associated with it. Okay? So that's the basic concept. Hopefully it'll go through without a problem, and I will see you guys tonight. Thanks. Bye.